Good afternoon. Have you practiced yesterday's questions? Did you feel it easy? Okay. Now, so in previous class, we have seen where standard costing in material variances, labor variances, variable overhead variances, fixed overhead variances, and sales variances. Now, so let us see material price variance. Now, what is the formula for material price variance? Material price variance is equal to actual quantity into standard price minus actual price. Let us say if you are getting an adverse for this one, what can be the reasons? If you are getting adverse, it means we are getting a negative balance. Either this is higher standard price, we are setting a bit more, let us say, sorry, either standard price we are keeping it as low, or else actual price is higher. Let us say we have fixed a standard price of 5 rupees, but purchase department is able to purchase for 7 rupees. Purchase department is able to purchase at only 7 rupees. It means they are spending 2 rupees extra, right? They are spending 2 rupees extra. Does it mean that purchase department is working inefficiently, or purchase department is not working efficiently? Does it mean that? Yes, definitely. As because we fixed a standard of 5 rupees, they are supposed to buy raw materials within that 5 rupees. If they are spending more than 5 rupees, it means that they are not working properly. Clear? So that we called purchase manager and we asked why we have incurred 2 rupees extra. Sir, this 5 rupees standard fixed 3 years ago. From 3 years, you keep on transferring the same 5 rupees to the next period. Or else, sir, how did you fix this 5 rupees? He asked us that, how did we fix that 5 rupees? So simple. Earlier it was 4.5. As every year inflation in India is 6% or 5%, whatever it might be, I'm applying the same percentage for all the materials. The average inflation might be 6%. Does it mean that inflation of every product in India is 6% or 7%? Definitely not. Sir, whatever the material you are asking me to purchase, now if you go and try to buy it, there is no chance that we can buy it lower than 6.5 rupees. Or he says that there is no chance that we can buy it less than 7. I purchased at the best possible level. That's what he told. After thinking a while, we thought that, okay, let us try once, let us get quotations, let us try it wherever we can get at lowest possible thing. So we asked purchase manager to leave for the day, and we took 5 or 6 days time. 5 or 6 days time, and then we came to know that yes, no one can buy at lower than 6 rupees. No one can buy at lower than 6 rupees. That is the least possible price what he can keep. It means our standard, whenever we are fixing and whenever we are planning something itself, we did not plan properly. We did not plan properly. So that while evaluating the variances, we will revise the standards. We will revise standards to revise the standard prices. Revise the standard prices 6. Am I clear with this, right? And now let us say actual quantity is 10,000. Actual quantity is 10,000. Now what is the total adverse we got earlier? What is the total adverse we got earlier? 20,000 adverse. Out of the 20,000 adverse, actually we got 2 rupees adverse, right? Out of the 2 rupees, 1 rupee adverse is not because of inefficiency of purchase department. It's because of not planning properly. We didn't plan properly. At the beginning of the period, while fixing standards, we have to plan properly and we have to fix the prices. So that is the reason why it is called as planning variance. It is called as planning variance. Now planning variance is 10,000 and remaining 10,000 is because of operational variances. That is nothing but because of operational inefficiency of a department. Operational variance is 10,000. Now sir, every traditional variance is not because of only inefficiencies or not because of not working effectively by the various departments. It might be because of due to poor planning also. So that furtherly we have to divide the variances into planning variance and operational variance. And planning variance is called as uncontrollable variances. Planning variance is called as uncontrollable variances. We cannot control them. Why? Because we cannot buy at lower than 6 rupees in market. Understood, right? We cannot influence the market to get at 5 rupees, right? So I can get a raw material from market where in the market availability I can buy at the lowest possible price, but I cannot influence the market to buy at lower price. It means that is uncontrollable. Understood, right? And then remaining operational things there, because of negligence might be, inefficiency might be of a particular department, now it can be controllable. Understood, right? So now to control that extra 10,000 rupees, what are the steps we are supposed to take it? So based on that, we can act accordingly. In the next period, we try to minimize this one, but this cannot be controlled. And in the next period, whenever we are giving standards, we are going to give standard according to the possibility from the market. I cannot buy it lower than 6, right? Then how can I fix a standard price of 5 rupees? Understood? Understood? So first thing, in yesterday's class we discussed something. Why we are calculating variances? To evaluate the performance of individual departments. But here today, in today's class, we are talking about whatever the variance we are getting is not just because of inefficiency of the various departments. It might be due to poor planning also. Clear? Now let us see formulas for planning variances and operational variances. Now first, material variance. Under material variances, no. Planning and operational variance is the next topic. Under that, material variances. First, material price variance. What is the regular formula for material price variance? So regular price is AQ into standard price minus actual price. This is the regular price. Clear? Now this is divided into two things: material planning variance and material price planning variance, material price operational variance. Clear? Now what is the formula for material price variance? Sir, planning variance in the sense, I have given 5 rupees, right? But I'm not supposed to give 5. How much I'm supposed to give? 6 rupees. So that difference has to be a planning variance. It should be the difference between standard price minus revised standard price. In planning variances, we should never include actual things, because that's about budgets, right? That's about fixing a standard. As because you are fixing wrong standard, how much is the variance you are getting? Understood? Okay. Now for examination purpose, sir, shortcut, how can we write the formula for planning variance or operational variance? Already you know the regular traditional formula, right? So for planning, as we as we cannot take actual, in the place of actual, you take revised standard. Understood, right? For examination, how to remember that? As I am talking about the planning, I cannot include actuals in planning. So in the place of actuals, I am taking revised planning. So what should be the formula now? AQ into SP minus revised standard price. Understood, right? Okay, next term. This one, AQ. Sir, as I replaced AP in planning, in operational, use revised standard in the place of SP. In the place of standard. That's what, right? Operational means you're supposed to take 6, but you have taken 5. Now you take 6. Yes or no? How much is normally we got 2 rupees variance, right? But actually, because of inefficiency, we got only 1 rupee variance. You are supposed to take revised standard, not the standard. Understood, right? So in the place of standard, you take revised standard. Revised standard price minus actual price. So the actual price has to be compared with the revised standard, which is nothing but the correct standard. So my inefficiency, you have to talk about the comparing my actual price with the correct standard, which is nothing but revised standard. Understood the formula, right? Clear with this? Now, what about material usage variance regular formula? SP into standard quantity minus actual quantity. This has to be the regular formula, right? Now, what about material usage planning variance? Material usage operational variance. Now, what has to be the formula? Same formula, standard price. In the place of AQ, I'm supposed to take revised. In the place of actual, I have to take revised SQ. And for use for operational, in the place of standard, I have to use revised standard. Understood? Because the sum of these two has to be equal to this one. If you rewrite the formula, if you see here, AQ into SP minus AQ into revised standard price plus AQ into revised standard price minus AQ into AP. And this will get cancelled, right? That should be nullified. Then we are going to get AQ into SP, AQ into AP, which is nothing but this one. Understood, right? We are just dividing traditional variance into out of the total variance which we already got, how much is due to pure planning, inefficient planning, and how much is due to inefficient performance of department. Clear? So this has to be standard quantity minus revised standard quantity. Now this formula has to be standard price into, in the place of SQ, I am supposed to take revised SQ minus AQ. Clear? Then what about material cost planning variance? Material cost planning variance, MCPV. Let's write the shortcut names for this so that we can use that formula there. This is MPPV. This is MPOV. This has to be MUPV. MUOV. Now material cost price variance is nothing but planning variance is nothing but material price planning variance plus material usage planning variance. And what has to be, there is no separate formulas for that, you don't need to use that. Directly, individually you found it out, add them. Material cost usage variance, material cost operational variance. Material cost operational variance has to be material price operational variance plus material usage operational variance, because regular formula we know that material cost variance is equal to usage variance plus price variance. Now also we are doing the same thing. Understood? Understood formulas, right? So do you want me to write formulas for labor then? Not required, right? What is material rate variance? Labor rate variance is divided into two. Labor rate planning variance, labor rate operational variance. Now what should be the formula for labor rate planning variance? Actual hours into standard rate minus revised standard rate. Standard rate minus revised standard rate. Now what is labor price or labor rate operational variance? Actual hours into revised standard hours or revised standard rate minus actual rate. Same formulas will be applicable and the same concept it will be applicable. Understood? So that's about planning variances and operational variances. Clear? And for examination purpose, you know that for planning variances, in the place of actuals you take revised one. For operational variances, in the place of standards you take revised ones. Clear? In every formula, that is the same thing for material, labor, variable overheads and even fixed overheads. Understood? Okay. Now see problem number 9. For planning and operational variances, I have taken two problems. Let's solve one. So green chemical produces agricultural fertilizers with the following information provided. The management analyzed past data and set budgeted rates as follows. Standard price per unit of the product is 1.1. Now they are fixing the standards just based on the past data. It means that they have not analyzed what practically happening outside, at what price here can really get from outside. From previous year to this year, a particular material can change a lot. Understood, right? But without considering all of those, just based on past data, he has given standards. Clear? Now what they have given? Standard hours per unit is 1.1. Standard direct labor hour rate is 18.5. Standard usage of material is 1.2 kg per unit. Standard price of material is 70. They are giving two datas. 9th one, right? One is about material, the other is about labor. Let's note it down one by one. Standard hours per unit. Standard hours per unit of a product is 1.1. Now standard hours is always calculated for actual output. Let us see how much is actual output. Actual production is 15,400. And what happens? Sorry, what should be standard hours? 15,400 into 1.1, 16,940. Okay, next, standard direct labor rate per hour, which is 18.5. That is nothing but standard rate is equal to 18.5. Next, standard usage of material per unit is 1.2 per unit. So standard quantity has to be 15,400 into 1.2, 18,480. Now standard price is equal to 70. Standard price is equal to 70. Next, during production times, the management revised the budgets with the updated information. Now during the production, they came to know that whatever the standards we had are not correct. Now we are revising the standards. What are that? Revised price of material per unit is 71. That's nothing but revised SP, which is 71. Now revised labor rate per hour is 20. Revised SR is equal to 20. Now revised hours per unit of a product is 1.05. Revised hours. Then what has to be? Revised standard hours, 15,400 into 1.05, which is 16,170. 178. 170. Okay. Then revised usage of material per unit is 1.175 kg. That is revised quantity is 15,400 into 1.175. 18,095. Clear. Next, actuals. Actual production is 15,400. Actual material usage is, it's nothing but actual quantity 16,555. Then actual cost of raw material. So AP is equal to 72. Actual price is 72 per kg. Then actual labor cost is, actual labor cost 16,632 hours. So that's nothing but actual hours is equal to 16,632. Then actual rate is equal to 19.5. Now calculate raw material and direct labor planning and operational variances. Now we are supposed to calculate both planning and operational variances. If they give like this, do not calculate material cost variance directly. Calculate price variance and usage variances, and cost variances for both planning and operational will be the sum of the cost and price. Sorry, usage and price. Okay. Now first one is material variances. What is material price planning variance? Material price planning variance, regular formula, actual quantity into standard price minus actual price. In the place of actual price, take revised standard price for planning. So it is standard price minus revised standard price, which is equal to, so what is actual quantity? 16,555 into standard price is 70, revised standard price is 71, which is 16,555 adverse. Next, material price operational variance. Under price only, operational and planning. Under usage again, planning and operational separately. So here it has to be, in the place of standard price, I am supposed to take revised standard price minus actual price. That is equal to 16,555 into what is revised standard price? 71. What is actual price? 72, which is again 16,555 adverse only. Clear? Okay. Next, material usage planning variance. Material usage planning variance is equal to, what is regular formula? Standard price into standard quantity minus actual quantity. In the place of actual quantity, I'm supposed to take revised standard quantity. So that is equal to, so standard price is 70. Revised standard quantity, so standard quantity is 18,480 minus revised standard quantity is 18,095. So that is equal to 26,950 favorable. Next, material usage operational variance is equal to standard price into revised standard quantity minus actual quantity, which is 70 into 18,095 minus 16,555. 1,07,800 favorable. Now finally, material cost planning variance. Planning variance is equal to, there are two planning variances for price and usage, just add them. That is 16,555 adverse plus 26,950 favorable. So net is 10,395 favorable. Next, material cost operational variance is equal to, price operational is 16,555 adverse, usage operational is 1,07,800. 90 245 favorable. I'm not applying for labor. You understood, right? Easy enough. So it's very simple that just in the place of, so for planning, in the place of actual, replace revised things. For operational, in the place of standards, use revised standards, so that you are going to get both planning and operational. Clear? Okay. Next very important topic is reconciliation. Are you sure about yesterday's preparation? Namacha? Okay then. Then if you really did yesterday's problems, then definitely reconciliation will be easy. Clear? Listen. And most probably every 2 attempts once, they are giving 14 marks reconciliation sum from standards, if you can observe previous questions. And if they're framing 14 marks questions from standard, 90% of the cases they are giving reconciliation question only. Understood? And it's very simple one. Listen. Reconciliation in standard costing. Now, what do you mean by usual reconciliation means? A reconciliation is a statement which shows the reasons why difference between two balances. Any reconciliation. A reconciliation means a statement which shows reasons between two balances. Let us say, if I'm having in my cash book, I'm having 50,000 rupees. But I opened my internet banking, I saw that there is 65,000 rupees. In my books of account, it is 50,000. In my bank, I am having 65,000 rupees. There is 15,000 rupees difference. then finding out the reasons why we are having that 15,000 differences, and if you are representing them in a statement, it is called as bank reconciliation statement. Yes or no? So let us say I have a vendor. My book shows that I have to pay him 40,000 rupees. But at the end of the month, he has sent me a report, his own statement. Whatever the transactions happened between me and him, he has given a month-end report. In that report, it shows that I have to pay him 70,000 rupees. Let's say my book shows 50,000 rupees I'm supposed to pay him, but his book showing that I have to pay him 70,000 rupees. It does not mean that I did some fraud or he did some fraud. Got it right? There can be some timing differences. Let us say in general in ERP tools, what do they happen is payment will be processed internally by one team and payment will be released by some other team. Understood, right? So I'm going to use my system and I will process the payment. Immediately after the processing the payment, journal entry will be happen at the end. After payment process, because of automation of accounting part nowadays, mostly in backend, it had a journal entry and their ledger has impacted that I already paid him. But there is payable team. What it right? Payment might be processed 1 or 2 days later. What happens is whatever the process I run, payment process I run, that will go to payment paying team. That will be in a queue. So all the processes, they will get in a queue and keep on paying them. That is on Friday evening. While he was paying, so 5 o'clock happened. After that, there are 10 payments pending. And as it was 5 o'clock, his duty is completed. He thought that he can come back on Monday and he will release those 10 payments. Understood, right? On between these 2 days only, he has taken a report. On Saturday or Sunday, he has taken a report. On Monday morning, he sent to me. My book shows that payment is happened, but their book shows showing that payment has not yet received. Understood? That is just because of timing differences. So likewise, even in standards also, there will be a difference in budgeted profit and actual profit, or a standard profit and actual profit. Now we have to show in a statement what are the reasons for their differences. Understood, right? Now what and all things I have to show? 2 things mainly. So, okay, mainly in examination they might give you 3 things. I have to compare budgeted profit versus actual profit, or standard profit versus actual profit, or last year profit versus current year profit. Clear? These are the 3 things which I am supposed to compare it. But I'm not going to give you 3 statements. In a single statement, I'll give a reconciliation statement between budgeted profit and actual profit. If in question is asking you from standard profit to the budgeted profit, what I'm supposed to adjust to get a standard profit, I will give in the same statement. From budgeted to actual, standard to actual also we are going to have in the same statement. Understood? Okay, we will see that one later. And last year profit and current year profit, if they have given, see, last year profit is considered as budgeted profit, current year profit is considered as actual profit. And however we have seen, however the statement we have drawn for budgeted profit and actual profit, the same statement you can use it for last year profit versus current year profit. Consider last year profit as budgeted profit, current year profit as actual profit, and show the differences between them. Clear? So I no need to give a separate statement for last year profit and current year profit, because it is the same statement as budgeted profit and actual profit. Clear? Got it. Now Now, so let us see the difference between budgeted profit, what is budgeted profit and what is standard profit and what is actual profit, how we are arriving them. If we get to know the how we are arriving them, then our reconciliation statement will be easy. You don't need to by heart any reconciliation statement. Clear? But just before going with this topic, they can give reconciliation statement either by using absorption costing method or marginal costing method. Understood? So before going to that statement, let us understand what is absorption costing and what is marginal costing. Clear? Sir, let us say I budgeted to manufacture 10,000 units, and I have given that variable cost per unit is 8 rupees and total fixed cost is equal to 1 lakh rupees. Understood, right? In a particular period, I have manufactured only 8,000 units. Or let us forget about the budget. I manufactured 10,000 units. I have manufactured 10,000 units. And variable cost which I incurred is 8 rupees. And fixed cost what I incurred is 1 lakh. Okay. Now, I sold only 8,000 units. I sold only 8,000 units. Now, what is the profit as per absorption costing and profit as per marginal costing? If you understand these two things, it will be easy. Now, what is cost per unit now? Cost per unit is equal to 8 plus 1 lakh, 1 lakh by 10,000. Variable cost is 8 per unit, total fixed cost is 1 lakh. So what is total cost per unit? 18 rupees is the total cost per unit. Let us say I sold 8,000 units. I sold 8,000 units at a rate of 20 rupees. Then what is the profit as per absorption costing? It is simply 8,000 into 20 minus 18, which is equal to 16,000 rupees. Clear? That is profit as per absorption costing. But under marginal costing, what they do is, first they will find out the contribution. First they will calculate contribution. So how much is the contribution? 8,000 into 20 minus 8. Contribution per unit is nothing but selling price per unit minus variable cost per unit. So how much is the contribution? 96,000. From that contribution, he will recover the total fixed cost. He will recover the total fixed cost, which is 1 lakh. So that loss according to marginal costing is 4,000. But profit according to absorption costing is 16,000. See, the main difference between absorption costing and marginal costing is, under marginal costing, we consider variable cost as product cost, fixed cost as periodical cost. We consider variable cost as product cost. Understood? It means that we are going to incur variable cost whenever a product is produced. And variable cost as period cost. It means irrespective of number of units you manufacture, in a particular period, fixed cost will be always constant. So, marginal costing says that I have to recover the total fixed cost in the same period irrespective of the sales volume. Understood, right? If I sell 8,000 units, if I sell 7,000 units, if I sell 6,000 units, as fixed cost is a period cost, I have to recover in the same period. Understood? So that with the sold units, they calculate contribution, and from that contribution, he will recover the total fixed cost. Am I clear? But in absorption costing, they won't do that. In absorption costing, both variable cost and fixed cost is considered as product cost only. Variable cost they will consider as product 1, and fixed cost it's also they are going to consider as product cost. It means that while they are calculating cost per unit, they will calculate including fixed cost. They will calculate cost per unit including fixed cost. But marginal cost never club those two. They says that per unit cost is 8,000 variable, total fixed cost is 1 lakh. They never convert fixed cost into per unit cost. Understood? Understood the difference between marginal costing and absorption costing? This much is enough for us at least. Understood? For reconciliation statement, this much is enough. One thing, only one point. In absorption costing, fixed cost is also considered as product cost. While calculating cost per unit, we consider fixed cost also. Clear? But in marginal costing, we never calculate fixed cost into per unit. We'll keep it separate. I'll keep just variable cost per unit and I'll keep total fixed cost separately. And I have to recover total fixed cost in the same period irrespective of number of units. Clear? Understood? Okay. If this much if you have understood, then definitely our reconciliation statements will be easy. Now let us take one example. Budgeted profit. What do you mean by budgeted profit? At the beginning of the period, we prepare a budgets, right? And based on those budgets, how much is the profit we usually has to arise is called as budgeted profit. Clear? Now let us say I wanted to start in a small, let us say I wanted to start a tea center. Got it right? Very profitable one. Even in summer, 2 p.m. in the afternoon, you can see in Udupi hotel, there are at least 10 people drinking tea. Understood, right? So very profitable one, I thought, and I thought to quit my teaching because here I have to convince a lot of people to get money. There I no need to. Just one stove, one gas, and making tea, and we can sell good amount of profit, right? Okay. Let us say we wanted to start it. Now I'm planning at the beginning of the period. Sir, I'm assuming that I can sell 1 lakh teas in a month. 1 lakh? Okay, don't 10,000 teas in a month. Clear? So I budgeted to manufacture and sell 10,000 units. I don't want to maintain any opening and closing stocks. Understood, right? I wanted to manufacture 10,000 units. My budgeted units. Budgeted units are 10,000 units. Now, under this, variable cost to make a tea is, let us assume that 3 rupees, and total fixed cost is equal to 20,000 rupees. And budgeted selling price is equal to 10. Budgeted selling price is 10 rupee. Then what will be my budgeted profit? What will be my budgeted profit? Let me take under two things. One, absorption costing. Under absorption costing, what we do normally? We calculate cost per unit totally. Now what is cost per unit? Cost per unit is equal to 3 plus 20,000 divided by 10,000, which is equal to 2. Clear? Under absorption costing, definitely I will calculate cost per unit, and based on cost per unit only, 5 rupees totally. Totally 5 rupees. Clear? Now what is my profit now? My profit has to be sale units into selling price minus cost. That has to be the profit, right? Profit is nothing but selling price minus cost is cost for profit per unit. Agree? Profit per unit, selling price per unit minus cost per unit will be profit per unit. Then how many number of units I am selling? 10,000. So my profit will be, budgeted profit will be 50,000. Now let's go for marginal costing. Under marginal costing, how do they consider? Variable cost per unit is 3 rupees. Total fixed cost is equal to 20,000 rupee. I will not club them. Clear? Now first I will calculate. Under marginal costing, always I calculate contribution first. What is my contribution? Total units sold into contribution per unit. That is equal to how much? 70,000. What is the formula for profit? Contribution minus fixed cost. This is the formula under marginal costing, which is equal to 70,000 minus 20,000, which is equal to 50,000. Sir, I am getting the same profit under budgets. Either it might be absorption or it might be marginal, profit will be the same. Every time profit will be the same under both budgets and absorption and marginal and under budgets. The reason behind that is volume is not changing, right? See, here I am converting into per unit, a fixed cost I am converting into per unit. For how many units I considered to convert? 10,000. And I also calculated profit for 10,000 only, right? I'm also calculating for 10,000 only. Yes or no? So that is the reason why there won't be much difference between, absorption costing and marginal costing profit under budgets. Clear? Okay. Now let us say, now let me talk about the actuals. Now, units produced is equal to, let us say, 15,000. Units produced is equal to 15,000. And variable cost is equal to, let us say, 3.5 rupees is the variable cost. And fixed cost is equal to, let's say, total fixed cost is equal to 22,000 rupees. Clear? And units sold is equal to 12,000 and selling price is equal to 12. Sir, I thought to sell it for 10 o'clock. Sorry, I thought to sell for 10 rupee. But even at summer at 1 p.m. by seeing the crowd, I thought that there is very high demand for tea. Even if I keep 12 rupees, definitely I can see the same crowd. That's what I thought. So I increased price. Even though after increasing price, I got more than my expected because I underestimated tea business. I underestimated and thought I can sell only 10,000. But I'm able to sell 12,000 units even after increasing the price. Got it right? That's what, when demand is coming, definitely we have to increase the price. Understood, right? Okay. Now let us calculate actual profit under both absorption costing and marginal costing. Now, absorption costing. Under absorption costing, what do we do? First, we calculate total cost per unit. Now, what is cost per unit? Cost per unit is equal to 3.5 plus 22,000 divided by 15,000. How much it will be? 4.9675. 7. Did we close that or we got something in points? Something in points we got it. Okay. Let's change that one. What is 22,000 divided by 15,000? How much we got? 1 point. Okay, 15,000 into 1.5. 22,500. Let's change that one. Yes. Because I have to match exact single rupee also, at least in example, so that you won't get confused. Because there I have to do reconciliation part, right? When we take in points, definitely we are going to get 3-4 rupees differences. So I don't want to confuse you, so that I am taking exact values. Clear? So let's take fixed cost as 22,500. $22,500 divided by 15,000. So what is cost then? 5 rupees is the cost per unit. Then what is profit now? Profit is equal to how many units I sold? 12,000. And each unit I sold it for 12 rupee. And cost per unit is 5. How much is total? 84,000 is my profit as per absorption costing. But what absorption costing happens is even for unsold units, both variable cost as well as fixed cost will be carried forward under absorption costing. But under marginal costing, we carry forward only marginal cost. We won't carry forward any fixed cost. For 3,000 units, right? If you see how much is cost per unit, how much is fixed cost per unit? 1.5. For how many units I incurred? 15,000 units. But I have recovered only for 12,000 units, right? For the remaining 3,000 units fixed cost, we carried forward to the next period. But marginal costing will not do that. In the same period, he will recover every fixed cost. So that under this situation, your marginal costing profit will be lower than the absorption costing profit, definitely. Understood? Because it will recover all the fixed cost. But here we recover only a portion of fixed cost. Some portion of the fixed cost is carried forward to the next period. As I carried forward some cost to the next period, current year P&L account shows more profit, right? I'm recognizing some profit some cost which I incurred in current period. I'm recognizing as a cost in the next period. It means I'm decreasing the cost in current period, right? Obviously the profit increases. Okay. Now let's go for marginal costing. They will not club variable cost and fixed cost. Then what is variable cost per unit? 3.5. What is total fixed cost? 22,500. Now first contribution. First they always calculate contribution is equal to 12,000 units they sold it for 12 minus 3.5. How much it will be? 1,02,000. Now what is profit? Contribution minus fixed cost. Fixed cost is 22,500, which is 79,500. See, absorption costing we got a profit of 84,000. Under marginal cost we got profit of 79,500. Now, sir, what is standard profit? Standard profit in the sense, first let us write the meaning. Standard profit in the sense, budgeted profit per actual units sold. Budgeted profit per actual units sold. That's what standard profit is. Understood? So let's go with marginal costing first. Sorry, absorption costing first. Now under absorption costing, units they will take from actuals, but revenue as well as cost per unit, all the things they will take it from budgets. So how many units it is? Actual units sold. So profit is equal to actual unit into standard profit per unit. Standard. When I talk about per unit, budget and standard are same. Per unit, per kg. Yesterday we discussed it at the beginning of the period. We are going to prepare for every unit, right? When I talk about per unit, budget and actuals are same. The same per unit if I apply for budgeted volume, it is budget. If the same per unit if I apply for actual, it is a standard. Agree or not? So that is the thing. That is equal to what is actual units sold? 12,000. What is standard profit per unit? 10 minus 5, which is 5, right? This is the standard profit, right? So that is nothing but how much? 60,000. Now tell me, what is the main reason why difference between budgeted profit and standard profit? Per unit it is same. The only difference between budgeted profit and standard profit is volume. Upon volume, margin per unit. Upon 10,000 is the change in volume. Sorry, 2,000 is the change in volume, and 5 rupees is the difference in profit. It means that the reason why there is difference between standard profit and budgeted profit is sales volume margin variance. Yesterday we talked about sales volume variance as well as sales margin volume variance. Both we have taken. What is sales volume variance means? Because of change in units, how much sale value changed. Understood, right? See, understand the difference between sales volume variance and sales margin volume variance. Sales volume variance means because of units, because of volume change in units, how much sale amount is changing. What is sales margin volume variance? Because of change in units, how much margin is impacting, how much profit is changing. It means these profit and this profit difference is because of sales margin volume variance, not sales volume variance. Margin in the sense, if I take sales variance, sorry, if I take sales volume variance, it has to be 10,000 into 10 minus 12,000 into 10. Understood? That is what sales volume variance. As per budget, what is sale value? As per budget, what is the sale value? 1 lakh rupee. 1 lakh rupee. What is standard sale value? Standard sale value is always for actual production. 12,000 into 10, which is 1 lakh 20,000. How much is the difference? 20,000 rupees is the difference. Understood, right? The 20,000 is the difference per 20,000 is the difference per volume, sale amount, difference of sale amount. But profit is changing by only 10,000 rupees, right? Now, when we are talking about sales margin variances, I told one thing, both from selling price, sales margin, so standard margin or actual margin, in both the margins, I'm supposed to deduct standard cost only. I'm supposed to deduct standard cost only, right? So after deducting standard cost from the sales, then we are going to get sales margin volume variance. Sales margin volume variance. Understood? Okay. It means that what is the reason behind these two? What is the reason for difference between budgeted profit and standard profit? Only one reason. What is that? Sales margin volume variance. That is the only difference between standard profit and budgeted profit. Clear? Understood, right? Okay. Then even let's go for marginal costing. What is contribution per unit? Sorry. What is contribution is equal to? Contribution is equal to 12,000 into selling price is 10, variable cost is 3. I will take actual sales, and this is nothing but actual sales into standard contribution per unit. Because standards are always per units, we take it from budgets, units we take it from quantity, we take it from actuals. Clear? Okay. So that is how much? 84,000. Next, what is profit now? Contribution minus fixed cost. That is 84,000 minus What is fixed cost? 20,000. As per standard, fixed cost is 20,000. Only volume only have to take it from the standards. Sorry, actuals. All the cost we have to take it from standards only. So what should be the profit now? Sorry, 64,000. 64,000. Understood, right? Now sales margin volume variance is the reason for absorption costing. If you see, not second one, only first one only. This is also first one. What is that? Sales contribution volume variance. Sales contribution volume variance. If you see, what is the difference between these two? If you see, what is the profit is changing by? Contribution is changing by how much? 14,000. Your profit is also changes by the same 14,000. It means in marginal costing there is one thumb rule. Anyhow, we are going to discuss it a bit later. After this class, I am going to start with after reconciliation, I am going to start with marginal costing only. Change in profit is always equal to change in contribution. Change in profit will be always equal to change in contribution. So contribution is the reason why there is difference between those two, and that contribution also because of change in volume only. Here I am taking volume of 10,000. Here contribution per unit, here also contribution per unit is same. I am taking contribution here for actual production, here I am taking contribution for budgeted production, so budgeted volume of sales. And the difference between these two 14,000 is because of first volume changing. So I have taken volume, and out of volume also contribution is the reason here, so that I have taken sales contribution volume variance, and this we are supposed to use during marginal costing. Clear? Understood? Okay. Now let us see what are the reasons why there is difference between standard profit and actual profit. Why there is difference between standard profit and actual profit? Let us see one by one. Is sales volume is reason? No, because when I am calculating standard profit, how many units I have considered? 12,000. Clear? When I have taken actual profit also, how many units I have considered? 12,000. In both the cases, I considered same number of units, 12,000 and 12,000. So volume is not at all the difference. But here I considered selling price as 10 rupee. Here I considered selling price as 12 rupees. Check in the profit formula under absorption costing. Here same 12,000, same 12,000. Here I am considering 10 rupees actual selling price, but here I am standard selling price, but it is actual selling price. It means selling price variance is one reason. Selling price variance is one reason, right? So that the first reason between those two is sales price variance. And remember, sir, sales price variance or sales margin price variance will give the same answer. Let me discuss why it is. So let us say I am taught to sell standard price is 10, actual price is 12. What is the difference? 2 rupees. What is margin price variance is? In the place of standard price and actual price, I have to take standard margin and actual margin. Yesterday's class, in the place of prices, I have to take margins, right? And while calculating the margin from standard price, I am supposed to deduct standard cost per unit, let us say 6 rupees. And here also I am supposed to deduct standard price, standard, yes or no? Now here it is standard margin is 4, actual margin is 6. What is the difference between these two? Anyhow 2. Because what is price variance formula? Actual quantity into standard price minus actual price. What is sales margin price variance? Actual quantity into standard margin minus actual margin. Difference between margin is 2, difference between price is also 2. Because from the selling prices, we have to deduct both. In both the cases, we have to deduct the same standard cost per unit. Clear? You have seen reason yesterday. Why should we deduct the same? Clear? So either I can take sales price variance or sales margin price variance. That is one reason. What is the other reason? The other reason is, here I have taken variable cost of 5. Here I have taken, okay, it actually matched the variable cost of 5, but here variable cost can be difference, right? Sorry, total cost. Here I got a total cost of 5, here I got a total cost of 5. Exactly, but if I take variable cost as 4 here, definitely this will become 5.5. So cost will be difference actually, because this cost we bought it from, sir, these 5 rupees we bought it from these here, and these 5 rupees they bought it from, sorry, these 5 rupees they bought it from this formula, and these 5 rupees they bought it from this formula. But exactly it is matching. I might have taken some other example. I have not observed that, otherwise I might have changed it. But you understood, right? These 5 rupees I have taken from this formula, but these 5 rupees I have taken from this formula. Here variable cost different and here variable cost is different, right? Here fixed cost is different and here fixed cost is different. It means 12,000 will be the same anyhow. Selling price will be different. Actually, cost also will be different. Both variable cost as well as fixed cost, both will be different. Understood or not? Variable cost as well as fixed cost, definitely both will be different. Clear? So variable cost variances. So variable cost means there are 3 variable costs for us: material, labor, variable overhead. I have not taken that 5. I have taken that as just a variable cost as the time, as this is an example. I have taken just variable cost per unit as 3. That variable cost will have material cost, labor cost, and variable overhead. Both will be there, right? So I have to take all the variable cost variances. It means I have to take material variances, labor cost variance, and variable overhead cost variance. Understood, right? In the place of cost, in the place of material cost, I can take price variance and usage variance, both. First, I have to take material cost variance, right? In the place of material cost variance, can I take both material price and usage? Or else in the place of usage, I can use mix and yield. It means what should I adjust? Either material cost variance or material price and usage variance, or material price, material mix, material yield variance. Anything is same. In the place of usage, I can use mix and yield. So why I am doing reconciliation? To know the reasons why there is difference between two profits. So as much segregation you can do it, you do such segregation in exam. Understood, right? Let us say you are having information to calculate only cost variance. Directly use material cost variance. But you have information to calculate both price variance and usage variance. Then calculate separately and use both of them in statement. Do not, if you are having information to calculate price variance and usage variance, it means we are having information for cost variance also. But do not calculate cost variance. Instead of that, calculate price variance and usage variance. As much segregation you do it. But why? Because the purpose of doing reconciliation statement is to know the reasons why there is difference in profits. Understood? Forget about the exam, but when you go for a real time, you have to do a reconciliation statement at the end of every month. As a cost accountant, definitely we should do reconcile between budgeted profit and actual profit. While you are doing that, whenever you are preparing a reconciliation statement, if you take only material cost variance, definitely top level management will ask you, okay, you given me a cost variance of 2000, but how do we got that variance? Is that because of which department it is? Yes or no? So that as much segregation you can do it, you have to do it. So, but definitely with this example, what we came to know, I have to adjust material cost variance. But in real time, what and all things I have to adjust? Price variance, mix variance, yield variance. By taking 3 or only cost variance, one and the same, right? Just to make you to understand, I'm taking that example. But I have to adjust 3. As well as labor variance is what I'm supposed to adjust. Labor, rate variance, labor, no efficiency. Because efficiency and subcategorized into 2, right? In the place of efficiency, what should I take? Mixed variance and yield variance and idle time variance. These 4. Because total cost variance is segregated into 3. What are those 3? Rate, efficiency, idle time. And efficiency again segregated into 2, right? So in the place of efficiency, I have to take mix and yield. Clear? In exam also, whenever they're asking you a reconciliation statement, based on the information availability for us, how much of the segregation you can do it, you do it. Clear? Okay. And third one is fixed cost. Third one is fixed cost. But here, fixed cost under absorption costing. Under marginal costing. So we have to take differently. Let us observe. Sir, what is the profit difference here? Once you check, listen very carefully. Here, how much is out of these 5 rupees, how much is fixed cost per unit? 2 rupees. Fixed cost per unit is 2 rupees, and here fixed cost per unit is 1.5 rupee. Understood, right? And here I'm taking fixed cost under absorption costing. If you see, I'm multiplying 12,000 into 2, and also I'm multiplying 12,000 into 1.5. Clear? It means our volume is not impacting. Our volume is not impacting my fixed cost. But which is impacting? Rate is impacting. And how do I get that rate? Here fixed cost is 20,000 and here fixed cost is 22,500. Yes or no? But here the same 20,000 is divided by 10,000. Here the same fixed cost is divided by 15,000. It means this 20,000 to 22,000 it is changing, and 10,000 to 15,000 is also it is changing. So 2 things we are changing here. Understood, right? So 20,000 and 22,000 is in the sense expenditure difference. Expenditure, how much I told to spend? I told you to spend 20,000 rupees, but you spent 22,500. It means that is called as nothing but expenditure. ఎంత ఖర్చు పెట్టమన్నాను, ఎంత ఖర్చు పెట్టారు. I told you to spend 20,000 and you spent 22,500. So absorption costing, one reason is expenditure variance and also volume variance. While absorbing, there is no change in volume, but when I'm calculating rate, volume is also impacting. So I have to take both expenditure variance and volume variance under absorption costing. Clear? Now under marginal costing, what I am supposed to take it? Under marginal costing, what I am supposed to take it? Let us see that also. Sir, here how much is the profit difference between here? Here 64,000 and here it is 75,500. If you observe, fixed cost here it is 20,000 and here it is 22,500. How much is budgeted fixed cost? 20,000. So 20,000 is impacted. How much is actual fixed cost? 22,500. 22,500 I have impacted. Let us say, if not 10,000, if volume is 12,000, still I might have deducted 20,000 only. Because under marginal costing, I never bother about volume. I will deduct total cost which is budgeted. Yes or no? Here let us say how many units I produced. How many units I sold? 12,000. Let us say if I might have sold 14,000 units. If I might have sold 14,000 units, how much I will deduct here? Same 22,500. Understood? But in absorption costing, it should be 14,000 into 1.5. Fixed cost, how much I might have deducted? 14,000 into 1.5 I might have deducted. Now how much I deducted out of this 5? 1.5 is fixed cost. 12,000 into 1.5. If I sell 10,000 units, 10,000 into 1.5. If I sell 11,000 units, 11,000 into 1.5. But in marginal costing, irrespective of the volume, I deduct the same 22,500. Here I will deduct the same 20,000. It means because of fixed cost, this profit is impacted by only expenditure variance. Only expenditure variance. Volume will not impact. So here I am supposed to take only expenditure variance. Clear? Understood? Got it? Now, sir, should we remember all these things to do reconciliation statement? This is just to understand what and all things to be considered, what are not to be considered. Just to make you to understand. Clear? Now, whenever they ask you difference between standard profit and budgeted profit, adjust only this. Adjust only this. Whenever they ask you reconciliation between budgeted profit and actual profit, then this plus this, both we have to adjust. Because if you see, how much is the difference between budgeted profit and standard profit under absorption costing? 10,000. How much is the difference between this and this? How much? From here to here, 24. Now from here to here, so that's nothing but always budgeted profit is equal to standard profit plus actual profit. Understood, right? So if they ask you difference between budgeted profit and actual profit, adjust both this and this. If they're asking you to draw only between standard profit and actual profit, then adjust only these things. Start with standard profit, adjust all these things, definitely we are going to get budgeted profit. Clear? Understood, right? Now finally let us conclude that one. If they ask you budgeted profit and actual profit, start with budgeted profit, adjust sales margin volume variance. Let's talk about only absorption. Let's talk about, sorry, forget about marginal. First listen very carefully. Start budgeted profit. If you adjust sales margin volume variance, what do we get? Standard profit we are going to get it. Yes or no? Only one adjustment only right here. For absorption costing I have to use sales margin variances. For marginal costing I have to use contribution margin variance. There is only one difference. The only difference between budgeted profit and standard profit is budgeted profit is budgeted profit for budgeted volume. Actual standard profit is budgeted profit only, but for actual volume. Only volume is the difference. As I'm talking about the profit variance, I have to take margin. If I have to take sale value, then I have to take in, then I might have taken sales volume. Understood? Huh? Clear or not? Clear. So start with budgeted profit, adjust only sales margin volume variance, you will get standard profit. To this standard profit, what and all things we have to adjust? First, sales price volume variance. Sorry, sales price variance or sales margin price variance. Anything you adjust it, because both are going to give you the same answer. Clear? After sales variances, you have to adjust cost variances. What are the cost variable things? Every cost you adjust it. Material cost variance, labor cost variance, variable overhead cost variance. Understood, right? Or in the place of cost, you can segregate them and adjust it. But anyhow, material cost variance, labor cost variance, and variable cost variance. Now, what about fixed cost, sir? Under absorption costing, you adjust fixed overhead cost variance. Or else we know that fixed overhead cost variance is nothing but summation of volume variance and expenditure variance. Adjust both. But under marginal costing, we should adjust only expenditure variance. Clear? Now, let me show you the statements also. Here, reconciliation statement is a statement which shows the reasons of differences in profits of below: budgeted profit versus actual profit, standard profit versus actual profit, or last year profit versus current year profit. Last year profit in the sense budgeted, current year profit in the sense actual. Consider that whatever the concepts we discuss now, apply the same concepts for budget and actual. So now reconciliation between budgeted profit and actual profit under absorption costing. First you take budgeted profit. To the budgeted profit, what I am supposed to adjust? Sales margin, volume variance. So which is nothing but AQ minus B. For sales variances, BQ and SQ is same, right? Clear? So into standard margin per unit, SM. Standard margin per unit. Then what we are going to get? Profit variance. Once we get standard profit, once we get standard profit, then we have to go for actual profit. First, selling price is the variance is there. So sales price variance or sales margin price variance, you adjust it. Anyone. Both will give the same answer. From that, adjust material cost variance, labor cost variance, variable cost variance. Either cost, if you take cost, that's fine. Otherwise, you take price and usage. Or you can take, in the place of usage, I can take mix and yield. Whatever it might be, material cost variance, I'm supposed to adjust it. Labor also same, variable overhead. And fixed overhead cost variances, I'm supposed to adjust it. Under that, you can take both expenditure and volume. Then, if it is based on marginal costing, only two differences. In the place of sales margin volume variance, but here you take sales contribution volume variance. Same formula, AQ minus BQ. There I have taken standard margin, but you take here standard contribution per unit. For margin variance, I have taken standard margin per unit. That's nothing but standard selling price minus standard cost per unit. What does standard cost per unit includes? Both variable and fixed. But here I will take only variable. That is the only difference. If you see, what is standard margin per unit here? 10 minus 5. Because cost per unit is both, cost per unit includes both fixed cost as well as variable cost. But contribution per unit, I will take only variable cost. That is the only difference, right? So we know how do we get contribution per unit also. It's nothing but standard selling price minus standard variable cost. Standard selling price minus standard variable cost, and we are going to get standard contribution per unit. That we have to adjust with actual quantity and for actual quantity minus budgeted quantity, so that we are going to get contribution. Rest of the things same: price variance, cost variance, cost variance, cost variance. But in under fixed overheads, there I will take absorption costing. I have to take both volume and expenditure, but here I am supposed to take only expenditure variance. Understood? So ignore fixed overhead volume variance under marginal costing reconciliation statement. With example, I have shown you very clear reasons why we are supposed to take like this. Understand that example. No, sir, we are not having time. We are not coming here for a regular class, 1 month only. At least remember the statement. You know how to calculate all these variances. Individual variances, you know it, right? At least we know it. Now, okay. Budget, adjust with margin sales margin volume. Standard we get. For the standard, all the cost variances I have to take it. Material cost, labor cost, variable overhead cost, fixed overhead cost. Only cost variances, we have to adjust it. Clear? But in marginal costing, I have to adjust only. Under fixed only, we have to adjust expenditure variance, not total cost variance. Volume we should ignore it. That is the only thing. Difference, you just keep it at one page, see the differences, you can understand it very properly. Clear? Okay. There is an alternative method also, but I'm not discussing that alternative method now, which is not suggestible also. In examinations, sir, what if they give alternative method questions? They can't give. For one problem only, either one of the method we can solve it. In your textbook, yes, some problems they have used this alternative method, but there also you can use the method which we discussed now. So the only change in alternative method is under absorption costing. What I'm supposed to adjust here? But if you adjust only sales volume variance, then for materials you have to calculate volume. It's straight away new variance. Have you seen material volume variance earlier? No, right? Under reconciliation you have to start. You have to find out one new variance, which is material volume variance, labor volume variance, variable overhead volume variance. Volume variance is very simple. Only difference between budgeted quantity and standard quantity. Understood? Whenever there is a quantity differences rate, which one I'm supposed to take, standard or actual? Whenever I show quantity variances, rate I have to take constant, right? Which rate I'm taking constantly? Standards only. That at least we can remember, because we applied the same for material, labor, variable overheads and all. Same apply the standards only, but it is the difference between budget and standards. Volume variances, even there is also this easy only. But in the place of margin, if you take only volume variances, for material, labor, variable overheads, volume we have to take extra. Usually for fixed overhead, volume we have to take it right there, but now we have to ignore it, because it is adjusted here itself. That values are adjusted here itself. I'm not telling logic behind all those things now, because which is not necessary as of now. Understood? Clear with this? So that's about reconciliation statement. Now, if you really understood the statement as well as this example, you can solve any kind of variance reconciliation problem. Any kind of reconciliation problem, if you have know the formulas what we discussed in previous class. Clear? Now, I picked very tough ones for your, sorry, tough problems. Two tough problems I have taken. Do not think that these are, and all the reconciliation problems will be like this. If you understood these two problems, it means reconciliation is done. Clear? It is not tough. Normally, market is feeling that two questions are tough, but that will be easy if you understood the real concepts now. Clear? So by solving those two things, we can close standard costing. Clear? So 10th question, I didn't solve this one. Sales price volume variance and sales operating volume variance, because it's already you're aware of. What is sales price volume variance? Sorry, sale price planning variance. Actual quantity into revised standard price minus standard price. No, for sales reverse, right? Actuals minus standards, right? In the place of actuals, I have to take revised, right? What is normal formula? Sales price variance. Normal formula. Actual price minus standard price into actual quantity. In the place of actual only, I have to take revised one. I didn't talk every time planning minus, I have to take it. Sales, it is reverse, right? Actuals minus. Just in the place of actuals, I have to use revised standard. What is operating formula now? Regular form. In the place of regular formula, in the place of standard price, you use revised standard price. So actual price minus revised standard price into AQ. And if it is a planning variance, in the place of AP, you take revised SP. So revised SP minus SP into AQ. Understood? As the same thing, I'm not solving it. It's a textbook question only. We can check the answer there. Clear? You understood what is planning and operational variances, right? You know the regular formulas. In the place of regular formulas, for planning, in the place of actual use, revised standard. For operational, in the place of standard use, revised standard. Understood, right? So, బండ గుర్తు పెట్టుకోండి, stone mark. Okay, keep that in mind so that you can solve all the planning and operational formulas, right? Okay. See problem number 11. So 11th one is easy only, 12th one only, it's still not even, 12th one is also easy only, not a complicated one. But we have to give some if you know the subject only, we can see this 12th one. Proper subjects you can get. Okay, anyhow, see problem number 11. Experimented produces and sells a single product. Standard cost card per unit of a product is as follows. Direct material A, these are the standards per unit. When do we fix them? At the beginning of the period. So for material A, 10 kgs we are supposed to use it at a rate of 5 per kg. For material B, 5 kgs we are supposed to use at 6 per kg. And direct wages, 5 hours at a rate of 5 per rupee, sorry, 5 per hour. And variable overheads again 5 hours at a, see, as I told you that direct and variable hours will be always same. There won't be any difference in hours because time given will be always same. Wages is 5 rupees per hour, variable overhead is 12 per hour. So standard fixed production overhead per unit. If it is, if they have taken per unit, this 25 is nothing but budgeted fixed overhead divided by budgeted volume, budgeted units. See, at the beginning of the period, fixed cost per unit, if you are saying, it will be based on budgets only, right? Understood? With actuals, how do I can find out at the beginning? Because actual units will get to know only at the end of the period. So this 25 we are getting by dividing based on budgeted units, budgeted fixed cost divided by budgeted units. So standard total standard cost is 190, standard profit per unit is 35, and standard selling price is 225. Fixed production overheads has been absorbed on the expected annual output of 22,500. This is nothing but budgeted volume. See, fixed production overhead, which is nothing but this, is calculated using budgeted production of 25,200. So there are budgeted units. Okay, units produced evenly throughout the year. During the month of December 2024, the following were the actual results for the actual production of. Actually, we are producing 2,000 units. Remember, these are annual units and these are monthly units. Annual output of 25,200 in the month of December. Understood? I cannot compare between those two. What it? So what should I do? How much is monthly standard? We never change actuals because what I'm doing under variance analysis, I'm evaluating the performance of various departments for the work what actually they did. Based on actuals only, I have to change accordingly budgets, and I have to prepare a budget at the end of the period for the actual output. Understood right now? What is budgeted output per month? 2,100 per month. Remember that. Clear? Now let us write. What is budgeted profit? Budgeted profit is equal to budgeted profit per month is equal to budgeted output into budgeted profit per unit. Agree? That is equal to how much is budgeted units, and budgeted profit per unit is given 35. Sorry, 35 given right already in question. Then what should be it? 73,500. Then what about standard profit? So standard profit is always for actual output into budgeted profit per unit, which is equal to 2000 into 35. So which is 70,000. What is sales margin volume variance? What is the answer for sales margin volume variance? 3,500, right? Up to now, that's what we discussed. What is the reason why difference between budgeted profit and standard profit? Sales margin volume variance only. Okay, let me calculate that also and I will show you, which is not required to solve the reconciliation because already we got standard profit, and at the end they're asking us calculate all the variances, prepare an operating statement showing standard gross profit, variance and actual gross profit. That's nothing but a statement which shows reason why differences between standard profit and actual profit. They didn't ask between budgeted and actual, but let me write it from budget to. Understood? From budget, adjust sales volume variance. I start with 73,000. If I adjust sales margin volume variance, I will get 70,000 definitely. In these problems, I no need to do that because already they given 35 per unit, right? If 35 per unit is a margin, for budgeted volume it is a budgeted profit. For actual volume it is a standard profit. Yes or no? Okay. Okay. And also explain the reasons if there is any difference in actual profit given in the question and calculated in above. So let us see one by one. Now let us see what actuals they given. Actual sales is 2000 at 225. Budgeted sale cost. Sorry. What is budgeted sales volume for selling price? 225. Actual selling price is also 225. It means price variance is 0. There is no change in price. So price variance is 0. Okay. Direct material, how many direct material, direct labor they have given, wages. So direct wages is given, production overhead, fixed overhead, total gross profit is given as 67,500 is the gross profit. Clear? Now I have to make a reconciliation statement between 70,000 rupees and 67,500 rupees. Why there is difference of 2,500 rupees? Clear? So to do that, I do require various variances, right? But here, see, in question they are asking, the material price variance is extracted at the time of receipt of materials. How much I consumed? 18,900, but material purchased were 20,000 at a rate of 5.25 kg. How much is 99,225 divided by 18,900? It has to be 5.25. It has to be. Clearer? Okay. Then 11,500 kg at a rate of 5.7. First calculate all the variances. So we calculate just relevant variances which is required for reconciliation statement. So to calculate all the variances, I should collect the data first. So first material variances. Standard price. There are two materials, right? actual price, standard quantity, actual quantity, revised standard quantity. Clear? What are the materials we are using? A and B. What are standard prices? 5 and 6. Actual prices 5.25 and 5.7. 5.25 or 5.25 and 5.7. Clear? Now standard quantity. Standard quantity of A. They said standard quantity is always for actual output. What is actual output? 2000 into, see, both of this has to be for actual output of 2000 kg. Clear? 2000 into, each unit requires 10 kg, right? Each unit requires 10 kg, so it has to be 2000 into 10, which is 20,000. So this has to be 20,000. Next, what is standard quantity of B? 2000 into, each unit requires 5 kg, so which is 10,000. So 10,000. Totally it has to be 30,000. And what about actual quantity? They already given 18,900, 10,750. How much it will be? 29,650. So here also 29,650. That should be in the ratio of 2:1. How much it is? 19,766.67. Then 883.33. Clear? Now I want, see, as of here, what and all variances I can find out for relevant variances? Material price variance, material yield variance, material mix variance. These three are relevant for to show in reconciliation statement. Which one I'm supposed to adjust in reconciliation statement? Material cost variance. But what did I told you? This material cost variance is segregated into price and usage. Again, this usage is segregated into mix and yield. If you add all these three, what happens? Cost variance only. So my statement should show all the possible segregation. So what are the variances I'm supposed to find out? Material price variance, mix variance, yield variance. Only these three. Clear? Let's calculate only those three. First, material price variance. Material price variance is equal to actual quantity into standard price minus actual price. Now what is actual quantity? At the time of purchase they are given, should I use these quantity or should I use these quantities? Purchased quantity I'm supposed to use it, right? So use them. So 20,000 into per A, 20,000 into standard price is 5 minus actual price is 5.25. For B, I'm not segregating, at least you know, I'm because due to time constraints I'm doing like this. What is per B? 11,500 into 6 minus 5.7. Calculate it quickly. 6 minus 5.7. 8,450. 8,450. Okay, that has to be the price variance. Next, or else I'm not doing mix and yield, I'm doing usage only, but you do it mix and yield later and segregate it. I'm using usage in reconciliation because I have to start marginal costing also. That is the reason. You understood, right? I have to adjust cost variance. Understood, right? But price variance I should show it separately because I will tell you the reason later. I'm using material usage variance. What is material usage variance? But you understood, you have to take mix variance and yield variance. Clear? Now what is material usage variance? Standard price into standard quantity minus actual quantity, which is equal to, for A, 5 into 20,000 minus 18,900 plus 6 into 10,000 minus 10,750. How much it will be? Price variance is? Okay, you said only this one earlier. Okay, it is adverse S. How much it will be? 1,550. Adverse or favorable? That's very much required. See, here you are going to get negative. Here we are going to get positive. So whenever you are using your calculator, 20,000 into 0.25 m minus. Here 11,500 into 0.3 m plus MRC. If you get in negative, adverse, positive, favorable, and you are going to get the final answer. Then why there is confusion? Understood, right? Or else you do 5 minus 5.25 into 20,000. You know that it is a negative. You know that if it is a negative, directly do take m plus only. If you wanted to use m plus, then 5 minus 5.25 into 20,000, m plus only use it. Don't do n minus. Why? Because already your answer is negative. Again, if you are doing m minus, so it will set off and it will give positive answer. So while using calculator, if you have taken 0.25 into 20,000, use m minus. Because you have taken positive value, right? 0.25 you have taken, not minus 0.25. But if you have in calculator, if you take 5 minus 5.25 into 20,000, your answer will be negative only. So do m plus only. In the m plus you get minus value. When you're doing addition, you're going to get minus. But when you're having minus value, again you are plus, you are pressing m minus, minus will set off and give the plus. Understood, right? So make it one habituation. Don't go with the both. Understood? Okay, how much is this? 1,000 adverse. Clear? That's about material variances. Next, let's go for labor variances. Let's gather the information first. What is standard hours? Standard hours is always for actual output. Actual production is 20. And how many hours per unit as per standard? 5 hours. So it has to be 20,000 into 5, which is 10,000. Standard rate is equal to, as per standard they are saying that rate is 5. Now what about actual hours? 10,500. What about actual rate? Yeah, actual hours paid 10,500. Actual hours worked 10,300. Then actual rate is equal to 50,400 divided by 10,500. Material favorable. Sir, if our reconciliation statement is not tallying, after that to find out reason why it is not tallying, it is very difficult. So give me calculations properly. You know it, we can do sum one more time than finding out where there is wrong. Understood? Okay. use m plus m minus very properly, or else do not use m minus, only m plus. Take the same thing, whatever there in bracket, 20,000 minus 18,900 into 5 m plus, 10,000 minus 10,750 into 6 m plus mrc. Clear? Habituate that only. So how much is this? 4.8. Now first, labor rate variance. That is actual hours paid into standard hours minus, standard rate minus actual rate. That is equal to actual hours paid is 10,500 into standard rate is 5, actual rate is 4.8. 2,100 favorable. Next, labor efficiency variance. What is efficiency variance? Standard hours minus worked. Efficiency, definitely they are going to take hours worked. That is 5 into 10,000 minus 10,300. 1,500 adverse. Next, labor idle time variance is equal to standard rate into actual hours worked minus actual hours paid. Sir, if you forget the formula worked minus paid or paid minus worked, remember idle time variance always has to be adverse. Due to idle time, definitely we won't get any favorable. Understood, right? Is idle time is good anytime? No, right? So definitely it has to be adverse. So even if you forget this formula, never bother. It has to be negative. Clear? So how much it will be? 5 into 10,300 minus 10,500. That is equal to 1,000 adverse. That's about labor variances. Next one is variable overhead variances. Variable overhead variances. Now, standard hours is equal to 10,000. Standard rate is equal to, because standard hours will be same for labor as well as variable overheads, it has to be the same. What is standard rate? 12. Actual hours is always, we have to take actual hours worked, so not paid. 10,500 and actual rate is equal to 1,15,000 divided by 10,500. 10 point. Continuous you are getting, or continuously just leave it? We already discussed, right? Continuously just leave it and calculate the variances. Now, variable overhead expenditure variance is equal to standard rate minus actual rate into actual hours, which is 10,500 into 12 minus 1,15,000 divided by 10,500. What is 10,500 into 12? 1,26,000 minus 1,15,000. That is 13,000 favorable. Next, variable overhead efficiency variance. 11,000 favorable. Efficiency variance is equal to standard rate into standard hours minus actual hours. That is 5 for 12 into standard hours is 10,000 minus 10,500. 6,000 adverse. Next, fixed overhead variances. BH if you can remember, I want only fixed overhead expenditure variance and fixed overhead volume variance. Expenditure variance is difference between BOH minus, okay, anyhow, let me write it quickly. I should confuse you. SHPR or SR SOH. Now, if you see, fixed overhead per unit it is 25. Fixed overhead per unit it is 25. Then what should be budgeted overhead? Budgeted overhead is per budgeted volume, which is 2100, right? 25,200 divided by 12. 2100 into 25. 52,500. Now what about budget hours? Budget hours is always for budget output, which is 2100 into 5 per hour. They told that how many hours are required as per budget? 5 hours. So it has to be 10,500. Then what should be the rate? 52,500 divided by 10,500. 5. This is 5. This also has to be 5. Standard hours has to be the same as earlier, which is 10,000. That's nothing but 2,000 for actual production. 2,000 into 5. Now SOH is 50,000 and AOH is actual fixed overhead 56,600. 56,600. Clear? So fixed, as I told you, fixed overhead is the one which we can do it very fast. Easiest variance are fixed overhead variance only. Clear? Now what is expenditure? $4,100 adverse. What about volume? 2,000, 5,000, sorry, 2,500 adverse. Just enough, those two. Clear? Now, finally, sales variances. And it is better to calculate directly sales margin variances. What it now? What is budgeted quantity or standard quantity? Both are same for sales variances, right? Which is 2,100. Actual quantity is 2,000. Now, what is standard margin? Standard selling price minus standard cost per unit, which is nothing but 225 minus standard cost per unit is 190. Given C in question. What is, as per standard, what is cost per unit? 190, right? So minus 190, which is 35. Already we are having, right, standard margin 35 given in question, right? Okay, then what about actual margin? Actual selling price minus standard cost per unit only, which is nothing but actual selling price is also 225. So actual margin also has to be 35. Now what about sales margin volume variance? When I take volume variance, margin standard has to be standard margin minus actual quantity minus standard quantity. For sales volume, so sales variances, first actuals minus standards we are supposed to take. That is 35 into actual quantity is 2,000 minus 2,100, which is 3,500 adverse. Budgeted profit minus 3,500 adverse, right? Has to be standard profit. Here, budgeted profit minus 3,500, how much? Did they match it or not? Clear? So it has to be, because the difference between budgeted profit and standard profit has to be margin volume variance. Now what about sales margin price variance? Sales margin price variance is equal to actual quantity into actual margin minus standard margin. What is actual margin? For actual quantity, 2035 minus 35, 0. Now let us go for reconciliation statement. If question is silent about it, is always absorption costing. Question is silent about it, it should be always absorption costing. What it? Now, first, what is our budgeted profit? We already calculated 73,500. To this, we have to adjust sales margin volume variance. If it is adverse, deduct. If it is favorable, add. Every time same. Then the result will be standard profit, which is 70,000. Clear? At least if you know the statement, if you can remember the statement also, that's fine. Clear? Logic's okay. After exam, if we do it, 1 month only is there, right? We cannot do all the logics now. Clear? Now, to this we have to adjust sales margin price variance or sales variances. It will be nil. Clear? See, first thing, property is what? Sales variances, cost variance, all thing we have to adjust. Sales total variance is nothing but margin and volume. Sorry, price and volume. So sales variance, see, first thing we have seen, profit divided into sales and cost. First we have to adjust sales variances. Sales variances, total sales variance is because of 2 reasons. One is volume and the other one is price. If you adjust only volume variance, we'll get standard. So to the standard, if we have to adjust sales price variance also. After adjusting that, we have to adjust all the cost variances. After adjusting that, we have to calculate all the cost variances. And actually there is one name to this one. If you want, just to understand in examination, you don't require to write. This is actual profit as per standard cost. This is called as actual profit per standard cost. Actual units. This profit is for actual units only, right? But per standard cost. So that's what. But don't require to know that point in real time. When you go for a job, they will use that name. Clear? But okay, now you don't need to write anything like. Now we adjust all the cost variances. First, material. In the place of cost variance, we use price variance, mix variance and yield variance. But I am using now metal price variance and usage variance. What are the material variances formulas we got? For answers we got 1500 adverse, 1000 favorable. So 1500 adverse, 1000 favorable. Next, labor rate variance. Labor efficiency variance. Labor idle time variance. What is rate variance? 2100 adverse, favorable, 1500 adverse, 1000 adverse. 2,100, 1,500, 1,000. Clear? Next, variable overhead expenditure variance, variable overhead volume variance. What is expenditure variance and volume? 11,000 and 6,000. So 11,000 is favorable, 6,000 is adverse. Next, fixed overhead expenditure variance, fixed overhead volume variance. So what is expenditure variance? $4,100 adverse, 2,500 adverse. 4,100 adverse, 2,000, 2,500. 2,500 adverse. This has to be actual profit. 1,550. Okay, adjust all those. $67,450. Clear? Understood? So what is actual profit? Tallying or not? Not tallying. Why? There is a difference of 50 rupees. Where did we miss? No, not that's the reason. That is. So that is the second question, right? That is explain the reason for the difference, if any, in the actual profit given in the question and calculated in above. Actually, we did not do anything mistake. Yesterday we discussed one thing. What we are supposed to adjust? Material cost variance we are supposed to adjust. But we have adjusted material price and usage. When will be cost variance is equal to price and usage? When price variance is calculated using consumption. But now we used purchase. That is the reason why there is difference. Understood? It means let us calculate. Okay. Third bit. The difference in actual profit, which is 67,500, and profit calculated above, which is 67,450, is due to material price variance. Material price variance. Understood, right? Usually to match material, as we already discussed in previous class, question might ask us to go for at the time of purchase, but to make it statements reconcile, it should be always based on consumption only, based on consumed only. Because here, at least here, if you take it, when they calculated this 67,500, they used consumed, not purchased things. So this while calculating this profit, they are using consumed values. Now, what is material price variance based on consumption is equal to 18,900 into standard price A 10, actual price of A is 5.25 plus 10,750 into what is standard price 6 minus actual price 5.7. Okay, that is okay, 10 kg at a rate of 5 rupees. Sorry, here it has to be 5. So how much it has to be then? $1,500 adverse. There we got 1550 adverse. Additional 50 we got it. Understood, right? What is difference between price variance based on consumption and based on purchased is equal to 1500 minus 1550, which is, that is what the additional profit we deducted earlier. So the difference between actual profit and reconciliation profit is also 50 rupees only, and this is the reason why there is a difference in profit. Understood, right? You don't need to show all those things, just you can tell the reason and you can leave it. Just to make you to understand why there is a difference of 50, we are writing all this. Understood about reconciliation statement, right? Clearer? It is easy that to the budgeted profit, you have to adjust sales margin, volume variance. First thing, sales variances. Total sales variance is volume and price. But here I am supposed to take margin variances. We have seen the reason why margin variances, right? So take both the margin variances. Here, if you take margin variance or just price variance, it will be the same anyhow, because your answer is going to get same. Now next, cost variances: material cost variance, labor cost variance, variable cost variance, and fixed overhead cost variance. They're subcategories. That's it. Adjusting all those things, then we are going to get actual profit. Clear? If the same question, if they're asking use marginal costing, then what should we do? What is variable cost per unit? What is variable cost per unit? Only up to this, right? 190 minus 25. 165. Then what is contribution per unit? Contribution per unit. 225 minus 165, which is 60. Understood, right? So here, in the place of 35, you take it 60. Then how much you get? 6,000. 6,000 only, right? So if it is based on marginal costing, here we are going to get 6,000 negative. And I should not take this thing. Volume I'm not supposed to take it, and rest of the things, everything is same. Understood? Now you take, you will get the same answer. Ignore this thing and take contribution variance of 6,000. Sir, here 2,500 we are not deducting. add 2500 to this one, it has to be 6000 only, right? So that is the difference between marginal costing reconciliation statement and absorption costing reconciliation statement. Nothing difference, only that. Easier? Understood or not? That is the only difference. Apart from that, there won't be any other differences. In the price, sales margin, volume variance, will take sales contribution, volume variance. What is sales contribution? What is sales margin? Standard margin into actual quantity minus standard quantity. But if it is a contribution, standard contribution per unit into actual quantity minus standard quantity. The same thing I have to take it, but in the fixed overhead, we should not take volume variances. The rest of the things will be the same. Clear? Understood, right? Okay. See problem number 12. Done. Now these are last year's information and this is current year information, and this is nothing but I should treat it as budget, and this I should treat it as actual. Clear? Now budgeted profit is 5, actual profit is 4. The total difference is 9. Total difference is 9, right? So why we got that 9 difference? But during 2021, average prices increased over those previous years were 20% in case of sales, 15% in case of prime cost, and 10% in case of overheads. That's what they given. Prepare a profit variance statement from the above data. So why there is difference in profit? Profit variance statement is something but reconciliation statement only. Why there is variance in profit? Clearer? Okay, let us see one by one. What is sales margin volume variance? What has to be sales margin volume variance? Or else let us say, just to make you to understand first, what is sales price variance? Sales price variance is equal to actual quantity into actual price minus standard price. That is equal to actual quantity into actual price minus actual quantity into standard price. Clear? Now sir, if you see here, they given the total sales amount. They are given total sales amount. But what did they told? During 2021, average prices has increased over those period as previous years is 20% on sales. It means sales increases by 20%. Sir, if sales increases by 20%, if you might have sold same number of units as earlier, my total sales has to be 120 plus 20%. Agree with that? Sir, if selling price is increasing by 20%, if selling price is increasing by 20%, my total sales value also will increases by 20% if volume is not impacting. Yes or no? But how much is 120? Sorry, okay. How much is 120 plus 20%? 144. It means that our volume is also changing. Actually, our volume is decreasing. Our volume had decreased. Agree or not? Agree or not? How much is our volume is decreased? Sir, if volume has not changed, my selling price is 144. Due to change in my volume, it is 129.6. What is the difference between those two? 14.4 divided by 144. It has to be 144, but it decreased by 14.4. It means 10% decreased. 10% decreased. Okay, let me write that working note first so that you can understand this later. See here, selling price is increasing by, first let's talk about sales variances. Selling price is increasing by 20%. Now, sales if no change in quantity in 2021. 21 has to be 120 plus 20%, which is 144. 144.44. No, 20% on it. They won't get in points anyhow. 144. Clear? Now, sales because of change in quantity is equal to 129.6. Therefore, percentage change in quantity is equal to, percentage change is always change in value by initial value, right? So what is change in value? 144 minus 129.6 divided by 144. Sir, change in value, if not change, how much? That's what change in value by initial value. Percentage is always. That's nothing but 10%. It means that our selling price is our selling price is increasing by 10%, but volume is decreasing by 10%. Clear? So last year 120 is the sales. Last year 120 is the sales. If price is not changing, how much might be my sales because of change in quantity? Minus 12. 120 minus 10%. Let's say if there is no change in price, only quantity decreased by 10%. What might be our sales? 120 minus 10%, which is 108. Yes or no? So 108 plus 20%. 129.6. Both way you can check it. 129.6 matching or not? So price is increasing by 20%. Volume is decreasing by 10%. Clear with that? If one is given, the other one we can find it out. Anyhow, they are given price is increasing by 20%. If price is increased, if volume has not increased, the sales might be 144, but now it is 129.6 only. It means there is decrease in volume. Now, what is the percentage of decrease? If no change, how much? Because of change, how much? Difference in that we can take percentage, right? Clear? Understood or not? Now you take, what is sales price variance? Sales price variance is equal to actual quantity into standard actual price minus actual quantity into standard price. It's an AQ into AP minus SP, right? As it is sales, actuals minus standards. What is AQ into AP? 129.6. AQ into AP 129.6. What is AQ into SP? What does it mean actually? For actual quantity, if selling price might have not changed, if selling price might have not changed, what might be the sales? That only. That's nothing but 129.6 divided by 120 percentage. Agree, sir? Okay, let me write this one bracket to make you to understand. Actual price is 120% of standard price. Agree this one at least, because price is increased by 20%. That implies standard price is equal to actual price by 120%. Clear? This you agree at least. Now let me write the formula. This is actual quantity into actual price minus actual quantity into actual price divided by 120%. Because I know what is actual quantity into actual price, which is 129.6. This is nothing but AQ into AP. This is SQ into SP. This is AQ into AP. Because last year things I have to consider as budget, right? Clear? Understood? Clear? How much? Okay. Then it has to be 129.6 minus 129.6 divided by 120% only. Sir, it is really not a complicated thing. It is a previous exam question. Most of the people felt that it was difficult. It is not at all a difficult question. Just try to understand what they have given. It's very, very simple one. Actual price is definitely 120% of standard price, right? Agree for that? Then standard price has to be actual price divided by 120%. The same thing I'm applying. I don't have standard price. I have SQ into SP I'm having, AQ into AP I'm having. Clear? But I didn't have AQ into SP. But SP is equal to AP divided by 120%. By applying that, I can have both, right? Then how much it is? 129.6 minus 108. Just now we have seen if price is not changing, only by changing quantity, then our sales might has to be 108, right? Just now we have seen that, right? So that is equal to 21.6 favorable. Next, sales margin volume variance. What is the formula for sales margin volume variance? Standard margin into actual quantity minus standard quantity. That is standard margin into standard margin into actual quantity minus standard margin into standard quantity. What is standard margin into actual quantity? Or else first, what is standard margin into standard quantity? Why? Sir, standard margin in the sense, standard margin into standard quantity is nothing but standard profit, right? What is my profit actually? 5 rupees. Understood? Now, what about standard margin for actual quantity? Now, listen. AQ is equal to 90% of SQ. Change in quantity, that is also decreasing. Understood? So it means AQ should be equal to 90% of SQ. Yes or no? Then definitely SQ should be equal to AQ by 90%. Clear? Okay, this is not required for us because anyhow I have standard quantity into standard margin. Now this has to be 90% of 5 because what is AQ? Sir, SM into SQ, or else let me write one more thing, one more formula. That is nothing but SM into 90% of SQ minus SM into SQ. SM into SQ I'm already having 5. Now SM into SQ into 90%, that is nothing but 90% of 5. Agree or not? So that has to be how much? 4.5 minus 5, which is equal to 0.5 adverse. Understood these two? Clear? Okay. Next, sales variance are done. Next, let's go for prime cost variance. They have not given material and all. Totally prime cost they given. Clear? Prime cost variance. What is prime cost rate variance? Prime cost rate variance is equal to standard rate minus actual rate into actual quantity. Rate is always for actual quantity. Now that is equal to standard rate into actual quantity minus actual rate into actual quantity. Clear? Then what is standard rate into actual quantity? If you observe here, increased prime cost is increased by 15%. Prime cost is increased by 15%. It means earlier it was 80 lakhs. Yes or no? 80 lakhs. Now if you see here, what is, first of all, what is AR into AQ? 91.1. 91.1. Now, what is standard rate? Standard rate is equal to actual rate is equal to 115% of standard rate. Yes. Then standard rate should be equal to actual rate divided by 115%. Clear? Then in the place of standard rate, it is 115% into, sorry, if I take actual rate, AR into AQ is 91.1 divided by 115%. Clear? Sir, simple. Standard rate into AQ. AQ means for actual quantity. Standard rate means what? If rate is not changing, how much is the rate? If rate is not changing, how much is the rate? Rate I didn't have it. But AQ into AR I am having. AQ into AR I am having. AR should be equal to 91 point. AQ into AR is 91.1. And AR is 15% more than SR. That's nothing but SR should be equal to AR by 115%. So this has to be there. So how much it will be? Tell me only this. 79.23 minus 91.1, which is 11.87 adverse. Clear. Next, prime cost efficiency variance. What is efficiency variance? Standard rate into standard hours minus actual hours. Now, standard rate into standard hours minus actual hours into standard hours. Clear. Now that is equal to what is, sorry, here you take hours. What is AH into SR? 79.23. AH into SR. AH into SR 79.23. Now what is SR into SH? What is SR into SH? What are these? Budget. What is SR into SR into SH? Standard cost only, right? This is nothing but okay, this is nothing but standard cost. Standard cost is but budgeted cost for actual production. What is the difference between budgeted quantity and actual quantity? 10% only. Then it has to be 80 into 90 percentage. Sir, in sales variances, budgeted quantity and standard quantity is same. But in cost variances, standard cost is always for actual production. Budgeted cost is 80. Budgeted cost is 80. Actual cost is, sorry, actual quantity is 10% lower than the sorry 10% lower, sir. Understood or not? Our units is decreasing by 10%, right? If my units is decreasing by 10%, my actual quantity is 10% lower than budgeted quantity. My actual quantity is 10% lower than budgeted quantity. Yes or no? Then SR into SH is nothing but standard cost, right? The standard rate into standard hours, that's nothing but standard cost is for always budgeted cost for actual production. Budgeted cost for actual production. What is budgeted cost for budgeted production? 80. Out of that, it has to be 90% then. Okay, take break for 5 minutes. We'll continue. Okay. First, before solving this one, I have to discuss two things. Standards are always calculated for actuals. The only difference between budget and standard is volume. Rate will not change. Rate definitely will not change. Clear? The difference between budgeted cost and standard cost is only because of volume. Clear? Budgeted cost is for budgeted volume, standard cost is for actual volume. Standard cost is budgeted cost per actual volume. Clear? Clear? That is one thing. And for sales variances, standards and budgets are same. Budgeted quantity and standard quantity will be same. Clear? So if you can understand that point, then now what is SH into SR means? This is standard cost. 80 is the budgeted cost. 80 is the budgeted cost. The standard cost is for actual production. Budgeted for budgeted volume it is 80. For standard volume it is 10% lower than that. Because what is the difference between budgeted volume and standard volume? For actual volume, 10%. That's what we calculated, right? That is the one we calculated here. Clear? So now this has to be, how much it has to be? 72 minus 79.23, which is 7.32 adverse. Clear? That is rate variance and efficiency variance. Then let's talk about variable overheads. Variable overhead variance. What is variable overhead variance formula? Variable overhead expenditure variance is equal to actual hours into standard rate minus actual rate, which is AH into SR minus AH into AR. Minus AH into AR, which is equal to, what is AH into SR? Or else first AH into AR, 24. This is 24. Now I know AH into AR, but SR I don't know. But one thing I know, that AR is equal to 10% increase means 110% of SR. That implies SR is equal to AR divided by 110%. Clear? So that's nothing but 24 divided by 110%. How, individually tell me, because I want AH into SR in some other formula also. How much it is? 21.8 818. Direct 82 only. Okay, 82 minus 24. How much? 2.18 adverse. Then what is variable overhead efficiency variance? Variable overhead efficiency variance is equal to AH minus, SH minus, because cost variance, right? Okay, standard rate into standard hours minus actual hours. That is equal to SR into SH minus SR into AH. This SR into SH is 90% of BH. I know SR into BH because standard rate and budget rate is same, but ours is 90% of BH, right? So what is budgeted cost? 20. So it has to be 20 into 90% minus SR into AH already I got it here, which is 21.82. So net answer 3.82 adverse. Clear? Next, fixed overhead variances. Now, fixed overhead expenditure variance, which is nothing but BOH minus AOH. BOH in the sense 15 minus AOH is 18.5, which is 3.5 adverse. Next, fixed overhead volume variance. Volume variance is SOH minus BOH. So SOH is nothing but BOH into 90%. Standard overhead is nothing but budgeted overhead per actual quantity, and actual quantity is 10% lower than budgeted quantity. So its cost has to be 90% of that, minus BOH is 15. How much? 1.5 adverse. Every time fixed overhead variance are easy one in any calculation, right? Okay, now we got all the variances. Now do reconciliation statement. First start with budgeted profit. How much is budgeted profit? 5. To that we have to adjust sales margin volume variance. So what is sales margin volume variance? 0.5 adverse. 0.5 adverse is minus. Now this is 4.5. This has to be, sorry, standard profit. Or else standard profit is always for actual output. Actual output is 10% lower than budgeted output. So for budgeted output, if it is 5, it has to be 90% of that. Cross verification, you can do like that also. This has to be 90% of this. Clear? Next, sales price variance. So how much is sales price variance? 21.6. 21.6 favorable only. Next, material price variance. What is material price variance? Sorry, they have not given material prime cost directly. Prime cost is 11.87 adverse, 7.32 adverse. 11.82, 7.87, 32. Prime cost rate, prime cost efficiency. It includes both material, labor and all. Next one, variable overhead expenditure variance, variable overhead efficiency variance. (2.18, 3.82). 2.18, 3.82. Next, fixed overhead expenditure variance, fixed overhead volume variance. So how much is fixed overhead expenditure? 3.5 and volume is 1.5. 3.5 adverse, 1.5 adverse. Total has to be actual profit. Adjust it. Actual profit has to be -4. Check whether it is tallying or not. Which one? So not tallying. It has to be 4, right? So it is not tallying. Let's check it. Budgeted profit, see, standard profit 90% is there, so it has to be correct. Price variance. Price variance to 21.6. So correct only. 21.6 favorable. Prime cost rate variance. 7.32. 7.23, yeah? 2, 3. Take 2, 3, now check it. Tallying, right? So that's it. Understood? Clear with this problem? It is easy only, not a difficult one. They're given for 7 marks in previous exam. But to do this sum, definitely your standard costing formulas is not enough. Conceptual clarity is enough. One thing, standard is always for actual, budgeted cost for actual output. So that is not applicable for sales again. So wherever I calculate the prime cost variance or prime cost efficiency, wherever I get standard hours into standard rate is nothing but standard cost. I'm taking just 90% of budgeted cost. I don't have SR, I don't have SH. But one thing I know, that budgeted cost is 80, and as volume is decreasing by 10%, it is for actual output is 10% lower than that one. So cost also will be 10% lower because it's a variable cost, right? What is prime cost is a variable, right? If prime cost is a variable cost, then it decreases by the same. If volume decreases by 10%, your cost also decreases by 10%. Clear? After this one, I'm going to start with marginal costing, right? In marginal costing, you really understand what will be the variable adjustment and how will be the fixed cost adjustments. There also you will get some clarity. Understood? Got it? So you have to work on that. Do not leave these kind of problems thinking that they are difficult. What it? If you are feeling something as a difficult, it means you require one more revision or some more time, 1 more hour we have to spend it. That's it. What it? In final, definitely we cannot leave anything. At least these kind of chapters where we can score it very well. Clear? Okay. Last one is budget ratio. Sir, I'm not talking any conceptual things here. Very fast I'm going to do it. There are 3 ratios. Efficiency ratio formula when they give R's. Remember what is efficiency variance? Fixed overhead variance is low. What is efficiency variance? Standard minus actual. Standard hours minus actual hours. But in minus, I'm not keeping side. Instead of I'm keeping in between. That is the efficiency variance formula. Clear? SH by AH. Next, capacity variance. What is capacity variance? Capacity ratio. AH minus BH. So AH by BH. Next, activity ratio. That's nothing but the percentage of work done. Clear? This is nothing but efficiency ratio into capacity ratio. Activity in the sense volume. Volume also what? SOH by BOH. SOH by BOH. In SOH and BOH, both rate is same. BRSR cancel, then it has to be SH by BH. That's what the formula. SH by BH, or multiply these two things. AH get cancelled, SH by BH, or at least from volume activities, in the sense how much work we did. That's nothing but volume variance. SOH by BOH. They won't give overheads. Instead, they are going to give us R's only. So SOH is SH into SR divided by BOH is BH into SR. SR get cancelled. Then it has to be SH by BH. Clear? Variances means minus, ratio means divided by. The ratio in the sense how much of the work we did, how much time I have given, how much time I have. Let us say I have given 10 hours. You have taken 8 hours. What is variance 2? Favorable. Because you have taken 2 hours. What is efficiency? You are working little bit faster, right? I given 10 hours, but you have taken 8 hours. Your answer has to be more than 100%. When your answer has to be more than 100, it should be 10 by 8 or 8 by 10. 10 by 8 only. That is the reason why time given divided by time taken, SH by AH. Understood, right? But due to time constraint, I am giving easy method to remember the formula. Clear with this? So variances formulas apply in budget ratios. Clear? Fixed overhead variances. Efficiency, SH minus AH. Capacity, AH minus BH. Activity, how much of the work? SOH minus BOH. Remember, but in question they are going to give as only R's. Then anyhow rate, standard rate get cancelled. SH by BH. That's it. Clear? Usually it has to be SOH by BOH. 0, 0 cancel. In mathematics, right? But we should not cancel when 0 is in between two numbers. But still, that is the logic here. That is SH by BH. Product X takes 5 hours to make a product. Product X takes 5 hours to make, and product Y requires 10 hours. In a month of 25 effective days, 8 hours a day. In a month of 25 effective days of 8 hours a day. So what is BH? 25 into 8. 1000 units of X and 600 units of Y were produced. What is SH? 1000 into 5 plus 600 into 10, which is how much? 11,000. What is BH? In a month of 25 days, 8 hours a day were produced 50 workers into 50. 10,000 BH, SH is 11,000. What is AH? In a department, and budget hours of the year were, one second, in a month of 25 effective days, 8 hours a day, the company employs 50 workers. So this we can take it as AH, because actually they are working 50 workers, actual things, and they are working in a month of 25 days and 8 hours. And they have given budget hours for the year was 1,02,000. So 1,02,000 by 12. BH. $8,500. Clear? See, why I am taking these as actual hours? Why did I change? Because they told that the 50 workers employed in the production, they were employed. Understand? Actually, the 50 people are working for the same for the work, right? Standard hours is always for actual production. Actual production is 1000 units and 600 units, and they have given standard hours to make each production. That is SH. Now, what is the efficiency ratio? Efficiency ratio has to be SH by AH. So it has to be 110%. Now, what is activity ratio? SH by BH. 11,000 by 8,500. 11,000 divided by 8,500, 129.4%. Now what is capacity ratio? Capacity ratio in the sense AH minus BH, capacity AH minus BH, which is 10,000 divided by 8,500, 117.64%. What is 110 into 117.64%? 110 into 117.64%, 129.4, because activity ratio should be equal to efficiency ratio into capacity ratio. Clear? Okay, so that's about standard costing.